Yes, hello. Right now I'm reading The Intelligent Investor, Benjamin Graham, the professor of Warren Buffett, Columbia University. He wrote that book more than 60 years ago. It is how you, I read the German version of it. It's about how you be smart out there at the stock market. Before the stock market, way like 70 years ago, the stock market was a little mystic. So you had like a crystal ball and you looked in it. There were not so many rules, and people got excited, and there was all these waves of emotions went crazy. And so Benjamin Graham, he developed a strategy, how to invest smartly, intelligently in the market, and how to get to the inner value of a stock, and how to avoid stupid mistakes. And so if you look at it, he developed like on how you can develop kind of a measurement like book value. How much is the book value of a company? Compared with the market value? What is the dividend yield? And Benjamin Graham wanted always something back. Of course, a return dividend yield like 2, 3, 4%. And he liked stocks, of course, below book value or around book value, and other multiples like revenue multiples. So that's how he started to go with the analytic way onto stocks, look at them, analyze them. And Warren Buffett used these tools till today. He says that's the best book you need as an investor. And so what actually happens to it is all these bubbles you avoid because you look strategically on the stock market and especially on single stocks. So Warren Buffett loves all traditional companies and those that are valued fairly, and he goes against the mainstream. The mainstream, they pick something up, a trend, like right now we have 3D printing, and people pay like 200 times revenue and 255 times book value. And that's completely, I think it's outrageous. It makes no sense to pay that for a company that is not making money at all. And so when you boil it down, when you look into the heart of the strategy of Benjamin Graham and lately, and also Warren Buffett, is look what your company makes, kind of earnings, and that you have happy clients, and that it makes sense that it's growing constantly and that it pays a dividend. And it just has to make sense. And they don't run. Warren Buffett doesn't go after some bubbles. I think there are always some bubbles. Like I think there are like themes, like electronic cars that makes sense. But I think some of social media, these are great companies. But from a value point of view, Warren Buffett cannot find it attractive to him. It's too risky because there's also especially in the internet, there are a lot of companies that grow, but if they have a disappointing quarter or year, those stocks can drop a lot. And that's what Warren Buffett doesn't find fundamentally it is worth it. It's too risky for him. And so he stays away from technology because they always have a premium, and he has IBM, but it's a more than 100-year-old company that pays dividends for 80 years or so, and there's a PE ratio that makes sense. But other companies he would not touch because it's just sometimes outrageous. So when you look at trends, Warren Buffett stays away from them. He buys like a railway company, or he buys oil company, and people think oil is over. The time of oil is done. But Warren Buffett sees it in a different way. And what else is smart grid is a little bit pricey right now. You have always these themes what the masses go after and pay a premium price, and then 10 years later the thing levels out, and then there's right now retail, all traditional retail is out fashioned and people avoid it. Like I think Walmart and other stores, like the retail stores and fashion and clothes stores, are out of fashion and they are very cheap priced. And people now, they buy, they pay a tremendous price for social media stocks. They may be in 10 years, maybe much higher, but you don't know. So there's so much risk involved in it. And the intelligent investor just goes for things you can measure and you can rationalize. And that's actually everything is behind that. You want a dividend yield, you want a fair price, a good deal, and not 100 times book value. That's all for today. Okay, bye.